VanEck comes out and says if the dollar loses reserve status, gold could surpass $39,000. It says, what if gold replaced the U.S. dollar as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price target for gold.
Game is on. Silver's going to launch versus gold. It's now up to 2% of the price of gold. Last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. You could see silver this year, $300 to $500 an ounce.
Using a log, 96 is the measured move target using a linear scale. But if you look at that move from $4 silver up to 50, that's about an 1,100% move. Let's just call it 10x for easy math. 10x on 50, that gives you a log scale target of $500 silver. I think that's realistic.
VanEck has sparked intense discussion in financial markets by suggesting that gold could surge to $39,000 or even $184,000 per ounce if the U.S. dollar were to lose its global reserve currency status. The analysis values gold by aligning central bank monetary liabilities with existing gold reserves, implying a massive revaluation of precious metals. This scenario also strengthens the bullish case for silver. Over the past year, silver has doubled its relative value to gold, rising from 1% to 2% of gold's price. Historically, silver has shown explosive upside during precious metal bull markets. Using logarithmic price projections, analysts estimate silver could reach $300 to $500 per ounce, positioning it as a high upside asset in a potential monetary reset. Now, we present the clips from Theirs interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
As far as I'm concerned, gold is doing what it's doing by default because there is no replacement for trust, period. And I think that's what it comes down to. And when you see interest costs exceeding defense spending, you can see that the system has chosen its path with it, which is debasing, printing, inflating, whatever the hell you want to call it. But this is why central banks are buying gold. This is why silver is being drained. And this is why the paper promises are BS, and they're starting to show up as such. And now let's just talk about a few other things. Going back to the financial advisors, I hear this a lot lately. You need to sell. They're looking at the charts. They're looking at the ratios. They're looking at the headlines, the ETFs. They don't look at the deliveries. They don't look at the lease rates. They don't look at backwardation. They don't look at who's shipping the metal out and who's buying it in. Where is it going? By the time this system admits stress, the positioning opportunity is already long gone. So I don't know. I just wanted to say that. Let me see, do I have anything else here? TD, I talked about. Oh, there was an interesting report in the written by VanEck. Did you see that? Financial advisory. They said if the dollar loses reserve status. Now, what have I been saying? I've been saying it is my belief that they want to soft default on the reserve status. It's what they want to do. They want to no longer be the world reserve currency over time in order to bring back manufacturing. Triffin's dilemma says you cannot do it if you are the world reserve currency. Vice President Vance has written about it, talked about it. Jared Bernstein, the knucklehead from the chief economic advisor from the Biden administration, wrote a report, Dethrone King Dollar. It is very much well known if you retain world reserve status, you will never have a trade surplus. And I think that's where they're going. We've talked a lot about that. I mean, I've gone over it copiously on many podcasts, but VanEck comes out and says if the dollar loses reserve status, gold could surpass $39,000. And it says, what if gold replaced the U.S. dollar as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price target for gold. And if they were to divide central bank MO, which is the most immediate form of money in the system, they come up with $39,000. If they use M2, it's $184,000. So anyways, the bottom line is you got a mainstream financial advisory saying, well, what if? What does that mean? I don't know. When people hear that it's James Rickards doing it, that goes in one ear and out the under. And out the other. I wonder what they'll say when VanEck is doing it. Trade a freedom or a liberty for safety. You never get it back. Something along those lines. Well, I would say the same thing here. When you trade, give up physical possession for convenience, you're going to regret it. You're not going to get the same thing back. Now, the reason people hold PSLV and PHYS aside from the fact that Eric Sprott and the name Sprott is the top of the food chain, and certainly a whole hell of a lot better in my mind than holding SLV and GLD, which I consider to be the worst products I've ever seen, is that it's a closed-end fund versus an ETF, meaning that you are eligible for regular capital gains, not the collectible capital gains rate that you find with with SLV and GLD. So certainly you wouldn't want to do that. But look, when people are thinking, what should I do? Should I own PSLV, third largest stockpile of silver in the world or so, held by a great company, metal stored at the Royal Canadian Mint? Well, number one, I can take possession of it. Okay, in 10 1,000-ounce bars minimum. And the management fee that you're paying is between 40 and 50 basis points. I believe you could store physically in a Brinks facility for less than that, and the storage in a Brinks facility is tax deductible. It becomes part of your cost basis. If you spend $100,000 on gold and silver and have $1,000 storage bill, your cost basis becomes $101,000 after the first year. So not only is it less, the storage rate probably going to be less than the basis fee that you're paying Sprott to begin with, in terms of annual fee, maintenance fee. You get the ability to stand for physical delivery, and it's tax deductible.
Growing stress in the global financial system is driving renewed demand for physical gold and silver. With U.S. interest costs now exceeding defense spending, many analysts argue the system has chosen inflation and currency debasement. Central banks are responding by aggressively buying gold, while physical silver supplies are being drained. A VanEck report adds fuel to the debate, suggesting gold could reach $39,000 to $184,000 per ounce if the dollar loses reserve currency status. This shift aligns with Triffin's dilemma and a potential soft default of the dollar. Meanwhile, distrust in paper gold, ETFs, and unbacked promises is rising, pushing investors toward physical metal ownership and direct delivery solutions. Let's get back to the interview.
We think gold and silver are going up a lot more this year. A lot more. Okay. Multiples more. But silver is going to beat the pants off of gold. Silver is very depressed to gold. We all know that. It's been depressed for a long time, so that hasn't worked. But the technicals that say it's shifted into an outperform versus gold occurred in November at the close. By our metrics, we said, okay, game is on. Silver's going to launch versus gold. It's now up to 2% of the price of gold. Last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. And if you go back in history and look at where was an ounce of silver versus an ounce of gold as a percent, let's say the 1980 bull market peak when we hit $50. That old range, okay? It was at 6.5%. 6.5. We're at 2, okay. And in 2011 peak, when we hit 50 the second time, it was at over 3%. We're at 2. Our technicals show us that spread relationship is broken out, and we're likely, think about this, silver's been in a 50-year, half a century dull range, suppressed, whatever. Gold hasn't been. Gold blows the heck out of every prior bull high. Copper's not where it was back in the 1970s, 80s, 90s, 2000. It's 4 times that price. Silver, for some reason, has been contained. Whether that's manipulation or a combination of events, it made a mistake. And whenever markets make a mistake, they tend to compensate for it and quite often overcompensate in a tantrum. This has happened many times in markets. It's not usual, but it happens. Copper did it in 2005-06. Lead did it in 2007. We quadrupled in a couple quarters to a new reality. If silver does that, our projection is you could see silver this year $300 to $500 an ounce. Okay, now, much of that should occur within the first couple quarters of that spread breakout, meaning much of it should occur by middle of this year in a thunderbolt tantrum move. This event that's going on now with T-bonds could help speed that up because it panics the central bank. And if you're an investor and you look at the horizon, what do you got? Do you want to buy the stock market? The world's selling it now. You want to buy the T-bonds? What's left? What's doing well? Well, what your buddy down the street told you 6 months ago that he did, and you didn't do it. You buy silver. Instead, all we're hearing on the internet is let's short it, let's short it. It's over, it's over. I think this surge that we get in the immediate horizon, if those T-bonds slip a bit more, could take silver well past 100, which might be sort of a normal guy's expectation of where the doubling of the old $50 high, And you get a midpoint stumble in this 6-month explosion, which we do expect to get a midpoint fake out stumble. Where's it going to be? Is it going to be at a logical level, or at some level it just turns people's heads, like $130 or so? These events that are now going on with T-bonds could precipitate that.
Silver is poised to dramatically outperform gold as the precious metals bull market accelerates this year. Technical indicators show a decisive breakout in silver's relative strength versus gold since November, with silver doubling from 1% to 2% of gold's price in just 1 year. Historically, silver has traded between 3% and 6.5% of gold during major bull market peaks, suggesting significant upside remains. After spending nearly 50 years suppressed while gold and copper surged, silver appears positioned for a powerful catch-up move. Analysts project a rapid tantrum rally, potentially driving silver to $300-500 per ounce, fueled by bond market stress and investor flight to hard assets. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.